if somebody's doing it themselves, I would encourage them to wear all the hats so that you know what's going on. I personally prefer the fund structure because you're able to add multiple assets.
They start in residential because it's like the most easiest to get your hands on. Like you said, it's pretty accessible. And then they eventually figure out.
A lot of people don't even know that you can go and buy a Starbucks. Was at that old private equity group. I was a team of 1 at one point. When I left, I was a team of 6. So I knew how to do what every person on that team of 6 did because I was a team of 1 doing that for 5 properties.
Hey, what's going on, you guys? Got another episode coming at you. We got a exciting guest today, Zane Schartz. He's an investor, does a lot of triple net deals, is really just focused on creating passive income and retiring not just himself, but others as well. So super excited to have you on, Zane. Thanks for joining us.
Thanks for having me. Ready to roll.
Yeah. So kind of like, what we always kind of like to start with is kind of understanding like how you got into commercial real estate and like your backstory. So if you don't mind, go ahead and start and sharing your backstory.
Yeah. So when I was in college, I was sitting in a gen ed class, and I was just bored. And I was like, what do all the richest people in the world do? So I went to like Forbes top billionaires, and I was kind of looking through it and was doing like a comprehensive analysis of like the world's richest people. And they either inherited it, they either created a product or service, they were either in tech or they were in real estate. And I didn't have any of those first 3. So real estate was the most obvious pick for me. And, I think real estate's very accessible. And my parents owned some single family rental properties. So like I always understood the value of cash flow. But with that knowledge of knowing that real estate was a good way to build wealth and generational wealth, I ended up getting internships throughout college. Every summer, I did a different internship at a different type of real estate. Worked at development firms, private equity groups, brokerage firms. So kind of just like learned what I wanted to do and fine tune more of what I was going to do. And I kind of landed on private equity and hit it off with a private equity group in Dallas that I ended up working for about 6 years and saw a lot of success there. So that's how I got into real estate.
Yeah, that's pretty cool. I'm glad you mentioned that, you've done an internship and multiple times, throughout college. I think a lot of people, they don't, and they wait until junior or senior year and they're like, ooh, I don't know if I 100% want to do this. My story, I was in the military, but prior to I was in college, I did ROTC and stuff like that. And I'd already kind of like figured out what my, first next step was. And I thought it was going to be JAG when I got into the military. I had to actually like get in first before that I could move to JAG. But doing an internship in college made me realize, don't really want to do, law my whole life. And I kind of like, repositioned myself to be an entrepreneur, real estate, that kind of thing. So that's pretty cool.
Yeah, I'm curious when you were sitting in that class researching this stuff and you're looking on the list, was it were those people in commercial real estate or were they in residential real estate or both?
A lot of them, like the bigger ones, were in commercial. A lot of them owned like thousands, or well, at that point, tens of thousands of multifamily stuff. And, when you've got billions of dollars, you're probably diversified throughout real estate and throughout commercial real estate. But I don't think any of these multi-billionaires in the top 100 are owning single family residential properties. There's bigger ways to do it from an economies of scale standpoint. And that's probably why they own the bigger buildings.
Yeah. So is that really kind of what pushed you into going out and looking for a commercial real estate opportunity, like to work with a commercial real estate?
Yeah, I think I knew that commercial real estate had the highest potential and the highest ceiling for economies of scale. And I also knew that I didn't want to do single family because seeing what my parents did, and they were landlords. You got to get a call on the weekend and fix the toilet, or, somebody's moving out next month or month to month, and there you go. You got to figure that out. So, I saw that and I was just like, I'm not sure that's what I want to do. But I also saw the potential for commercial real estate being much higher. And I knew that if I combined my work ethic with a little bit of luck and God's favor, that it might land in a good position.
That's awesome. Yeah, that's interesting because I think most people, I'd say like the majority of people, at least who I've talked to, they start in residential because it's like the most easiest to get your hands on. Like you said, it's pretty accessible. And then they eventually figure out, not everybody switches out and thinks, residential real estate kind of sucks. But a lot of people do get that like, oh man, I got to go and answer this call about a toilet in the middle of the night or whatever, all the stories you always hear. And then they say, well, let me try it. What's like the next step? And a lot of times the next step is commercial real estate. So I think it's interesting. You kind of just jumped right into it. That's a good thing, I think.
Yeah. I think I was very fortunate in that private equity group that I ended up working for 6 years. The timing aligned perfectly, and I stepped into a situation that was growing very fast. I mean, I stepped in. I think I was the third employee, and when I left, we had 20 plus employees, and we grew from $100 million of assets to 700 plus million. So being part of that growth was very fun, but also I was just very fortunate to have that door opened. And, I don't take any credit for that. I just kind of stepped through the door that was opened. But yeah, from a single family standpoint, the accessibility is very good. And I understand why a lot of people start with that. They want to put their money to work. They want to get into real estate. And that's just kind of like the first step that most people know about. A lot of people don't even know that you can go and buy a Starbucks or invest into a fund that buys Starbucks. So I think the education for that isn't out there on as broad of a level as it should be. So, people are just like, I want to get into real estate. What does that mean? Oh, I'm just going to buy a second house, So I understand it, but, the education that y'all are doing is great.
Yeah, I appreciate that. That's kind of the goal, because there's really, there's definitely some really, really good programs out there for people who want to get into commercial real estate, but there's not a lot. So that's kind of what we were thinking. Let's go out and kind of document what we're doing in our journey and share it with other people so that they can hopefully learn alongside with us. But for people who don't really know, we know, but, walk us through kind of what a private equity firm does, and then also kind of walk us through your experience in that 6 years of what you were doing while you were there.
Yeah. So broadly speaking, private equity just means you take investors' money and you buy anything with it. So we're a private equity real estate investing firm, meaning we specialize in using investors' money to buy real estate. And what we do is we basically take all the active work that somebody who wants to invest in real estate would typically do as a landlord, but we take that away from the investor. So all they do is give us their money and we do all the work for them. We buy the properties, we manage the portfolio, we work with the tenants. We are the ones getting calls on roof leaks and potholes and, tenant maintenance, that we're the ones doing all that. So we take all the work and the landlord responsibilities away from the investors, and they just collect checks and mailbox money. Passive income is the goal, and we have been able to do that for a very long time. So when I was at that private equity group, we executed that, and we ended up building a lot of different investment opportunities. But I was really in charge of, so I was the chief investment officer there for almost my whole time there, because like I said, we only had 3 people there when I first went there. So I was in charge of the triple net funds. So we ran funds where investors could buy into a fund, and then that fund would go acquire a triple net property, meaning, so for those who don't know, triple net means the tenant's responsible for taxes, insurance, maintenance, and they reimburse for all that, or they pay it directly. So we ran these funds, and I ran them directly, and went from acquiring the properties to working with lenders to working with brokers and everything, managing the whole portfolio. I ended up leaving that company a couple of years ago, and after I left, just ended up absorbing those funds through a vote that investors took. So I'm now the manager, and Freedom Commercial Real Estate is now managing those funds. So that was an interesting transition, and something that was a huge honor that, 400 plus investors saw value in what I was doing and what I could do for them. And they took a vote to have me run those moving forward. So that's a little bit about private equity, and can go into.
Yeah, that's 2 quick things I want to mention. One, basically what he's describing for everyone listening, we've talked about it a little bit on the show before, but he's basically talking about he was the GP, and the investors who are putting money in were the LPs, the limited partners, and we've discussed that a little bit in other episodes. But the second thing I wanted to mention, you hear a lot of people debate like doing a fund versus doing a single asset syndication. What do you think? Well, I guess one, kind of give us a general high level of what each one is, and then what do you like? Do you see a benefit in doing a fund over a syndication? Now, obviously, it's not for somebody who's just starting, but once you continue to grow and you get your feet under you, and then maybe could be a good step to scale pretty quickly after you get used to commercial real estate.
So like a single asset syndication has value. So like we offered that at the old firm I worked at, but we would buy like one apartment complex, and we would syndicate the equity through 100 plus investors. So we were the GPs, we brought in 100 LPs and syndicated one asset. So with that one asset, let's just say you have one location. So if that market takes a turn for the worse, you may be diversified over 200 units, but you're not diversified in terms of geographic location. So I personally prefer the fund structure because you're able to add multiple assets to one investment for an LP investor. And with those multiple assets, you have diversification across all of them. So as an investor in a fund, all of our funds have 10 to 20 different assets in them, which means 10 to 20 different geographic locations, 10 to 20 different lease terms, probably 5 to 8 different industries and tenants. So you're very diversified, meaning your risk is lowered. And the more you diversify, the lower your risk is across the board. So that's diversification is huge. And for me, that's why I prefer a fund over a single asset. But I do see value in a single asset offering as well.
Yeah. So talk a little bit more about what kind of investments you're looking for. You mentioned multifamily, but I think you guys do a lot of like triple net. So if you describe to everybody like what you guys are currently doing, what you guys have in a portfolio, that kind of thing.
Yeah. So I guess I'll tell you the why before the what. What I wanted to build was something that was very stable, very consistent, very low risk, very diversified investment for LPs. So I thought, what's the best way that I can do that and create a diversified pool? And to me, I don't know of a better way to do that than when you own a property and the tenant paying your rent is an investment grade multi-billion-dollar corporation. I've been doing this now for 8 years, and I've never had to chase rents. I've never had to reach out to a tenant and say, hey, you forgot to pay your rent this month. Every tenant we work with is a multi-billion-dollar corporation like Dollar General, Starbucks, AutoZone, Verizon, where we're getting paid by the corporate company. We don't own any retail centers, no mom and pop pizza joints, no mom and pop nail salons, no franchisees. Everything we have is very low risk in terms of collection. And then on top of that, not only are the tenants amazing, but the diversification of having it in the fund structure allows investors to get the benefits of diversification as well. So I wanted to create something that was as diversified as possible. And as of today, all of the properties we have are those single tenant net lease properties with multi-billion-dollar backed leases. And because of the consistency of the rent and we put fixed rate debt on everything, we're able to send out monthly distributions to our investors. So we send out monthly mailbox money to all of our investors because it's so stable and consistent. And it's our investors love it. And we have a lot of repeat investors, and it's a good part of an investor's portfolio that's very consistent.
That's awesome. Where are most of these located? Are you across the country, or do you have a specific region you focus on, or specific state? Or
yeah, so we're currently in 18 different states. We have 70 plus properties, and all of them are east of Texas. So kind of the Sun Belt region, but we also have some in Ohio. We have some in New York, but most of them are the Carolinas, Florida, Texas, Georgia, Oklahoma, kind of that region. But we're not super specific to any location because we're fully reimbursed for taxes and insurance. So we do try to avoid the coast for hurricanes and natural disasters or stuff that we can't control, because on some of our assets, we're responsible for roof and structure repairs. So if we can be as far away from possible from a hurricane, we'd like to avoid that. But owning a property in Tampa, Orlando, those are great markets, and we don't avoid them, but we're careful with where we buy.
Gotcha.
Yeah.
I'd be curious to know how you guys have kind of, maneuvered through the market with all of the changeover with the, Family Dollars and the Dollar Generals, and what's the other one I'm thinking of? But, with the merger of Dollar Tree.
Yeah. So some tenants are better than others, and some tenants were better 5 years ago than they are today. Walgreens is going through some issues. We own a couple Rite Aids that went bankrupt. We have 2, and Family Dollar is going through some stuff with Dollar Tree. So our strategy, you have to adapt. So we have adapted and kind of shifted away from some tenants and kind of lean more towards others. And the important thing is the piece of real estate that you're buying. You have to own a good piece of real estate, because, for example, using those Rite Aids, they're on great pieces of real estate, and even though Rite Aid's gone bankrupt and they're not going to pay us rent anymore, we have new tenants that want to move in there. And after these new tenants move in, the valuation of the property is actually potentially going to be higher than what we paid for it. So, owning a good piece of real estate is important. knowing if this tenant isn't as good as we think, will a better tenant move in? And, what's the replacement cost? What's the rent per square foot? Like, there's a lot of stuff that goes into our pre-acquisition criteria that we look for. And, the tenant is probably number one, the strength of the tenant, but also the strength of the real estate is a very close second.
Yeah. That's kind of something I was going to ask, but you pretty much answered it. But for the people listening, being a broker, you hear a lot of hesitancy towards triple net. Not a lot, but sometimes people are hesitant towards triple net because they're like, well, if you buy a, for example, like Dollar General that's out in the country, they started shifting to try to come closer into cities and stuff. But let's say there's one in a very rural part of town and you pay $1.5 million for it at like a 7 cap. If they end up leaving, which like you said, a strong tenant, not a high chance of that happening, but after the 15 years, they might decide to leave and relocate a couple miles down the road. We've seen that happen. You got a probably $300,000 or $400,000 building after they leave. So once all the income's gone, because commercial real estate's valued on income, that piece of real estate is worth, way less than when you bought it for. So that's kind of one of the risks of triple net. However, what you just specified, I think is just something I've learned over the last, 6-7 years doing brokerage, is that the biggest part, it's cheesy, but location is so huge that it's a good location and it's a good piece of real estate. I'd be willing to bet the Rite Aids that you guys have are all probably on hard corners, which is huge. So that's just something to consider when you're looking at these assets, whether it's triple net or more of a mom and pop operation. You want to be in a very, very good location because that's going to protect your downside quite a bit, because then you can just refill it. Like you said, you can find another tenant, and even if Rite Aid leaves, you can have 10 different tenants wanting to go in your building because you've got good visibility, you're on a corner and all that stuff. So that was just something I wanted to kind of reiterate as I was thinking about what you're talking to the audience. But something I wanted to ask you, and you can get as specific as you want, but what kind of returns are like you getting your investors? And then also like what kind of cap rate ranges are you guys buying? Because like Jesse said, the market's been so crazy, interest rates are so high. We haven't seen a major adjustment in, like let's say cap rates at 7% and interest rates at 7%. It's hard to make the deal work. So how have you guys been making deals work? And then what kind of like returns are you kind of expecting and targeting?
Yeah, so all of our funds are different, obviously, because we've been doing it now for 7+ years. So the properties that we bought back in 2020, we may have bought at a 7 cap with a 3.5% interest rate.
Yeah.
But I'll just go off today's kind of rates. So the fund that we're currently raising for is for accredited investors only, but the weighted average cap rate is a 7.9% cap rate. I think the lowest cap rate in it is a 6.75, and that was a 10-year new build Starbucks. So we got it at a really good deal. And then the highest cap rate is 8.7. So kind of, there's a range between 6.75 and 8.7. And then our interest rates kind of range from 6% to 7.5%, I think is our highest. But that's why the fund structure is the best, in my opinion, because all these different properties are returning different rates of return. One thing that we have been doing with interest rates being higher is using lower leverage. So we're in the 40 to 60% LTV range. So our debt service is lower. It also lowers our risk to investors, but it also lowers our returns. So like on our older funds, our cash on cash was 8+% because our interest rate was so low. But on this current fund, we're cash flowing, I think 2024, our cash flow was 6.72% to investors, distributed monthly, but that was the annual rate. So our hope is to have that get up to the 7 to 8% range on current cash on cash. That's a good number, but really the value isn't only in the cash on cash number. We anticipate an 18 to 20% annual return when we sell it. And that's going to look like putting together, creating a fund, 15 to 20 different assets, extending all of the leases or as many leases as we can, making the weighted average lease term as long as possible, and also having the strength of the credit pool be as strong as possible, and then rolling it up and selling it to a private equity group, a REIT, a pension fund, an insurance fund. So we have 3 buckets of returns. We got the current cash on cash. We have the principal pay down and equity that we're building up on the loans. As we pay down the loans, we'll be able to unlock that equity when we sell it. And then we have the appreciation, which will come through either macroeconomic shift in a better direction with cap rate compression, interest rates coming down, cap rates follow. And then we can also manipulate the cap rates through lease extensions. So the value of these properties is all in the strength of the leases, as Graham said. So, we're able to create appreciation and hope for the market to add some appreciation. And even if it doesn't, like if the market takes a turn for the worse, we still have fixed income for the set amount of the lease in place. We have fixed debt for anywhere from 5 to 9 years, depending on the lease term. And we can cash flow at the current rate for a long time, really. But the exit strategy is to roll it up and sell it.
That's interesting. And so a lot of the people listening are wanting to go out and do this themselves, that kind of be in your position. I'm sure there's some people listening who are LP, but I think if I had to guess, the majority of the people are wanting to go out and get after these deals themselves and be on the GP side. So how do you don't have to be super specific, but as specific as you want, how do you make money on these deals? Is it acquisition fees? Is it the residual cash flows, a combination of both? Or like, how can somebody getting started, like if they have done real estate for a while and then want to go off and do their own thing, how can they structure it to make money themselves?
Yeah. So I'm a very simple guy, and we keep it as simple as possible. And we just do a 80-20 split, net revenue, net cash flow, meaning if the fund makes $100,000 next month, 80% of that goes to investors, 20% goes to the managing company. And then we do a 2% asset management fee to kind of help keep the lights on. And that's below market. Like, we're not using third party managers, which are typically anywhere from 3 to 6% on these type of deals. So we keep it in house. But I'm not a big believer in asset management fees. I'm not a big believer in acquisition fees. I'm not a big believer in disposition fees. I think an operator or general partner is incentivized to buy deals regardless of if they're good or bad, and sell deals regardless of if it's a good or bad deal. I think a couple things. I think a sponsor should be one of the biggest, if not the biggest investor in the fund with their own personal money and not acquisition fees that they're rolling in. So that's what I do. And then I think that, as a sponsor and a general partner, you have a fiduciary responsibility to help make investors money. Like, it's hard to find people who actually want to help investors and they're not in it for themselves. So as a LP, look for somebody who is genuine and wanting to help. And then as a GP, for people who do want to be GPs, like, start with family and friends, raise some money through them, put your own money into it, and you'll definitely be aligned if your parents' money are in it, if your money's in it, if your aunts, uncles, cousins' money is in it. You're going to want that deal to succeed. So if somebody's out there trying to do this themselves, I would encourage them to learn as much as you can, because handling other people's money is very important. You're working with mom and dad's retirement funds and kids' college funds. Like, there's a huge weight of responsibility in handling other people's money that should not be taken lightly. And I think you should seek as much education and like a mentor. And I honestly think the best way to learn is by being a passive investor and seeing how a GP does it, seeing what you like, seeing what you don't like, and then taking that knowledge and doing it yourself. So, there are some GPs out there that might be willing to kind of give some training or whatever and kind of just help you. But I think being a passive investor is a great way to learn. But if you don't want to be a passive investor forever, and your goal is to be a GP, you just got to step out there and do it and raise some money, which is the hard part.
Yeah, I 100% agree. There's so many, that's kind of the cool thing about real estate. There's so many different ways to skin that cat. And it just depends kind of on where you are at in life and what you have going on, that you could go to the LP side, you could go to the GP side. If you're young like us, you can even, work for part of the GP. We've done that as well. And I think education is the biggest piece of it. Like you said, if you don't know what you're doing, don't go buy anything just yet, do your homework first, like you will with any other investment, right? You don't want to ruin whatever family member's money you're borrowing or your own money, so be careful with that. I'm curious, I want to go back a little bit to when you left private equity for your own firm with Freedom CRE, and talk about that transition, how you built your team, that kind of thing, how you made that transition happen successfully.
So at the old company, the president of that company, he always knew that my goal was to do it myself and was to be a GP and be a sponsor. I think I told him that maybe on my first day of my first internship. I was like, I don't want to work for anybody. I want to be an entrepreneur, and I have that mentality. Yeah. So he treated me well and gave me the opportunity to kind of create my own company within a company. So with that, I was able to learn a lot about management. I had a team of 5 or 6 people working for me directly, and I did a lot of stuff. I really wanted to create my own company and run things my way, and he allowed that freedom, and I'm very grateful for that. So when I was ready to leave, I had confidence in my ability because I had done it. It's being an athlete, the best players want to play at the end of the game when the clock is running down and your team's down, because they're confident in their training, and they're confident that their preparation has prepared them to perform. So I was confident in that, and I knew I was ready to perform. And then from a team standpoint, we kind of hired the team slowly as the money started to come in, and I gave up some equity in some of our stuff to get some good employees. So we have we gave some equity to some people that have a lot of experience that typically probably wouldn't be working for a quote unquote startup, but they saw the upside and did that. And then I'd say, like, for somebody who's starting their own team, I'd say you should look for people that you trust. That's number one. Somebody that you trust and you can teach them what needs to be learned. But if you don't trust them, you shouldn't work with them. So that's a really big thing. Is everybody I work with and everybody that works for me, I trust at a very high level and allow them the freedom to do what they need to do to succeed.
That's cool. That's cool. I was going to ask, Jesse beat me to it, but like, what made you decide, like you said, you knew from day one you wanted to go out and do your own company, but what was kind of the reasoning behind wanting to do that? Was it just something that a lot of people just want to be an entrepreneur, or was there a specific reason that you wanted to go out and do your own thing? Or,
I think me and the president of that company just had some different views on some different ways to run business, and it was just kind of clear that it was time for me to leave and start the next chapter. And through a lot of thought, prayer, and seeking counsel, it became pretty clear that it was time to leave and do things myself. So I'm very grateful for my time there, but it was time to go.
Yeah, that's cool. Gotcha. So for somebody making the switch, what would you recommend? Because we talked a little bit about acquisition fees, and a lot of, asset managers and funds and stuff like that use those to, like you said, keep the lights on. But like, how would you recommend somebody transitioning into doing commercial real estate full time? I feel like that's one of the highest barriers to entry. It's like you go from working a regular job to, like a 9 to 5 to all of a sudden having potentially sporadic income. And, commercial real estate takes a long time to build up to where you can live off of the income. So like, what kind of advice would you give somebody who wants to make that jump?
My advice would be to find somebody you can partner with and bring them value. And through partnering with somebody who has the experience and bringing value, let's say you can raise $1 million of equity. Say, hey, I can raise $1 million of equity. I would like to be a co-sponsor on this, a co-GP. I'll bring in $1 million. And through that, you would learn how they do things. You would get a front seat ticket to how it's done by somebody who's hopefully done it for a lot of times. So that's how I would recommend doing it. I'd probably recommend starting as an LP, then going to a GP, partner. And then once you do that and you feel confident enough to go and be a GP yourself, then you have the experience and you can say, hey, investor, limited partner out there that I'm raising money from, I've done it as an LP, I succeeded. I've done it as a co-GP, I've succeeded. So now you create a track record, you've created trust, you've created value. And then you say, hey, I'm going to go do it myself. And here's the project. And I would say start on a deal that is going to be a win. Don't aim for the fences, kind of just get on base and know that, you made investors money, even if it's not a 2x, 3x, even if you make a 1.7x, like you're going to make investors happy. Capital preservation is huge, and start slow, grow slow. A good quote is inch by inch, life's a cinch, yard by yard, life is hard. So, take it slow and growing away. So that would be my answer, is find somebody you can partner with and add value to them and that you trust.
That's awesome.
I wanted to talk about, the social media, the content and stuff like that. That's how I found you on LinkedIn. Talk about how that's kind of like transformed your investing and fundraising and how that's benefited you.
Yeah. So I have 400 plus investors, and I haven't done a single bit of marketing up until about a month ago. I never did anything. My first thing ever was LinkedIn post. So we started on LinkedIn and just started posting about what we did, and it's had some pretty good traction. I think we've had a couple posts with 200,000+ views and reached, 200,000 members. So it's a lot of people and a lot higher success rate than I anticipated. But I think it's just proof that people like this stuff. People like these tenants that they know, and they probably aren't even aware that you can buy a Starbucks or you can buy a Dollar General. So just trying to tell my story a little bit about what we do, how we do it, why we do it. But it's been wildly successful. I've probably had, in the past month, 100+ new investor calls, all people that have pretty much seen me on LinkedIn. And, with that comes more equity. With more equity comes the ability to buy more properties, and the more properties you buy, the more diversified your funds are, and everybody benefits from it. So it's been very successful. and I'm very happy about it.
That's awesome.
Yeah. I just think it's so obvious through your posts, through the way you talk about your funds. It's very precise what you guys are looking for, what you guys are, doing, the why. It all makes sense. It's all very organized, and it comes off that way too. And I think that's also part of the success. I was curious what posts specifically, if you don't mind sharing, that had that much views, and why you think that they did that well.
Yeah. So the two that I've done the best, the first one was the Starbucks post where I kind of talked about the cap rate that we bought it at, the location that it was across the street from a new casino development, like just the growth of the area and why we bought it. That one, I think it had 250K views, and that one really, I think that was my first post. So it was pretty wild. And then we had another one of an O'Reilly Auto Parts store property that we bought, and we extended the lease prior to acquiring
Closing,
it.
yeah, I saw that.
Yeah, so like we increased value before we closed on it, and we're able to unlock that potential prior to. So I think people just like to see how things are done and why things are done. Like, why did we choose that Starbucks? Why did we choose this O'Reilly? How did we do this? Creating value is important. And then like, I'm pretty transparent with the numbers. Like a lot of people, I feel like don't want the numbers out there. And like, they're like, well, if you want to know about the numbers, contact me. And I'm like, I'm not hiding anything from anybody. I'm here to help. And there's enough properties out there for everybody to win. And, I'm not a greedy person. And ultimately, I do what I do because I love it. And if I didn't love it, I wouldn't do it. And, I love helping people make money. I love buying properties. I love the competitiveness of it. And I think if you're passionate about something, it'll come through in your work and it'll come through in your post. So I'm hopeful that that's been the case.
Yeah, definitely. You mentioned something that ties into a question I was kind of going to ask. You've been very humble. I don't think you mentioned while we're recording yet that you played, hockey at a college level and then at a professional level, which is really cool. Do you see, and I'm sure you do, a benefit from your athletic training and kind of just being on the sports teams that translates into the commercial real estate world? You mentioned how you love being competitive, and I think obviously that's a big one, but is there other ways you've seen that kind of help you out?
Yeah, I think like playing high level sports and just playing sports at, any level, you have to have a drive to succeed. You have to be willing to do the hard things with the end goal in mind. Being a high level athlete, I've been through a lot of stuff that isn't fun with the end goal in mind. So, putting in the hours, putting in the work, talking to the 100 brokers to get the one who brings you the deal. That's all fun. But, you said outside of the competitiveness, is there anything? For me, the competitiveness is the number one thing. And it's like, how can I make this fund as good as possible? And for me, that's the fun part, is like, how can I paint a picture or create a puzzle that has all these pieces and make all the pieces as good as possible, so the return and the end product is as refined and as good as possible. So it's kind of like reverse engineering from the championship game at the end of the season, going back to the beginning of the season and being like, what are we going to do to make it to the championship game and win? And how are we going to refine our craft to create the best fund or the best team to maximize this investment? So it's fun. There's a lot of pieces to it. And I think being an athlete has helped me a lot.
That's cool. Curious, where did you play professional level?
Yeah, so I played at the AA level for different NHL organizations. So I played in Orlando. So I played for Tampa Bay Lightning's minor league team. I played for Detroit Red Wings, Toronto Maple Leafs, probably 5 or 6 different NHL organizations. And then I played in Europe for a little bit. I played in Finland, Hungary,
cool.
Germany. So, a couple of different spots, and just really enjoyed my journey.
That's awesome. That's really cool. So one of the questions I had for you, two questions really, because you said you had almost 70 properties across 18 different states, and you don't use third-party management. And I saw your website, and it doesn't look like you have too many people working for you. So how do you guys manage all of that? Do you have like one person specific, or do you just how do you handle that, and how would you advise somebody to be able to manage such a big portfolio?
Yeah. So we have a team of 5, myself included. We have one property manager, and she's across all 70 properties. But, these 70 properties, sometimes you won't hear from a tenant for years, and sometimes you won't hear from, sometimes you'll hear from a tenant once every other month. So, it's very sporadic. It's very cyclical in terms of kind of repairs and roof repairs and parking lot repairs, but she's project managing all of that. So she does the actual day-to-day management. She does a great job. She's a great asset for the team. And then we have 2 accountants. One of them's a CFO level, 40 plus years experience. He was a CFO at a couple companies. And then one of them's a bookkeeper. And they both do a good job. And the numbers are so important. You got to make sure numbers are where they should be. So that's why my first hire was that guy with 40 plus years experience. And then we have a marketing person who helps raise some equity, who was in the corporate marketing place for 35 plus years. And then there's me. So I wear a lot of different hats. I'm an entrepreneur, and I'm doing investor relations, I'm doing portfolio management, I'm doing lease management, I'm doing a lot. And so far it hasn't been an issue. I think I have a pretty high threshold because of kind of my sports background. But I think we can keep our team in place for a pretty good time, until probably the next hire would be another property manager to help that property manager. But she's fine and she's happy where we're at. But so I'd say, like, your question was, what should somebody who's looking to start a team? You can third party a lot of this stuff out. Or was that your question?
Kind of just like, how do you manage it, and how would you recommend to other people starting out managing it?
Yeah, I'd say, like, you can third party out. The first thing you're probably going to want to do is accounting. Make sure your accounting is good.
Mm-hmm.
And then if somebody is wanting to do something, I think, like, doing it yourself and knowing how to do what everybody on your team does is important. So when I was at that old private equity group, I was a team of 1 at one point. And when I left, I was a team of 6. So I knew how to do what every person on that team of 6 did, because I was a team of 1 doing that for 5 properties, when I think I did it by myself up until about 20 properties. I did everything. So that was a great learning experience where I learned the property management, the project management, the, lease, like just everything. And then I hired my first, and then we went. So if somebody's doing it themselves, I would encourage them to wear all the hats so that you know what's going on.
Cool. And who does the acquisitions for you guys? Is that mostly you?
Yeah, that's all me. So I'm the one actually picking the properties to go into the funds. I'm the one working with the brokers, working with the tenants prior to acquisition, post-acquisition. I'm the one working with the lenders, finding the debt. So from an actual portfolio management standpoint, that's all me.
That's awesome.
Something I wanted to ask was, you're pretty prevalent about your relationship with Jesus, and wanted to see how you incorporate that in commercial real estate.
Yeah. Thanks for asking. I was waiting for that.
Yeah.
Let me smack this one out of the park. Yeah, I mean, my faith is the most important thing about me. The Lord changed my life, and everything that I do is just a byproduct of my faith. I believe that this life has one purpose, and I'm trying to live that purpose out. And I want people to know about the hope that changed my life, and that's Jesus. And money is a resource that everybody wants, but it's what you do with that money that's important. And my goal is to fund missionaries around the world to tell people about the hope of Jesus. So my long-term vision is I want to give away $1 billion to fund Christian missionaries to tell the world about the hope of Jesus, because there's eternities that can be impacted by this. And the way I want to do that is through creating a fund, a charitable fund, a nonprofit fund that will buy cash flowing commercial real estate assets that go into a bucket that is used to fund that work around the world. So, I'm very outspoken about it. I try not to be annoying or brash about it, but I think if you're passionate about something, you'll talk about it. And if you think that it has the implications that I believe it has, then I should probably be talking about it more. And, money is my part of the team and telling the world about Jesus. There's missionaries out there who go knocking door to door or talking to people in different countries, and I want to be the part of the team that funds them. So that's why I do it. That's what I'm passionate about.
Yeah, that's so good. I mean, we talk a lot about just trying to steward. You nailed it. Money's just a resource, and we really don't even own it. It's the Lord's, and it's just how good of a job you do stewarding your money and your resources, and also your skills. There's some people who are cut out to be missionaries, and they're very good at that. And then there's also people who, have a unique skill set that excel in commercial real estate, and then use that money to go fund those people. So I think that's really, really cool.
Yeah, for sure.
It's awesome.
You guys nailed it on the head. We're all a piece of the body, and we have to do our part. And while some I've, I don't know why, but I feel like I've come across a lot of Christians that just don't want to talk about money and they want to hide it. And I think it's important for generational spread that we share how to steward it correctly and, put it on mission for God. I think that's important. So yeah, I'm glad we talked about this. Is cool. Yeah, that's an ambitious goal. I would be praying and anyway we could support and help. We definitely will in that fund.
Yeah. I mean, I came to that goal, and somebody asked me once, if you knew you couldn't fail, what would you ask God for? And I said, I'd want to give away $1 billion. So God, that's not too big of a number for the creator of the universe to provide if that's what they want. So, and if it's not what is in the plan, then I'll just be faithful where I'm at. But, I think real ministry takes real money, and real money is a part of it. And like you guys said, just using the gifts that we've been given is worship. And that's what I'm trying to do.
Yeah. That's so good. Well, Jesse, do you have any other last questions? I think that's a good place to end it if you don't have any more.
No, I think that's a great place to end it.
Awesome.
Zane, it was a pleasure. And how would, if people want to talk to you, find out more about Freedom CRE, how do they get in touch with you?
Yeah, you can visit our website, which is freedomcre.net, or you can email us at info@freedomcre.net, or you can reach out to me on LinkedIn, Zane Schartz. Follow along for the journey. But those are probably the best ways to get a hold of me, and would love to help in any way I can and kind of talk about what I do and how I do it. Always willing to help.
Awesome. Well, thank you so much, Zane. We really appreciate it. Thanks everybody for listening to another episode of the Commercial Real Estate Blueprint, and we'll see you in the next one.